Hi, everyone. Thank you for having me. I'm Joe Ament. I am a PhD student at the University of Vermont, and I'm here to moderate the discussion on financing the transition, and I'm very, very happy to do so. Today we've got two great speakers. We've got Ralph Hall, who's an associate professor in the School of Public and International Affairs at Virginia Tech. His research and teaching focus on sustainable development, sustainable transportation, and water supply and sanitation in developing countries. He holds a PhD in technology management and policy, and as well as degrees in technology and policy and civil and environmental engineering from MIT. Jennifer Clapp is a professor in the School of Environment, Resources, and Sustainability here at the University of Waterloo. She's published widely on global governance of problems that arise in the intersection of the global economy, food security, and food systems in the natural environment. And her most recent research projects have examined the political economy of the financial actors in the global food system. So when I was asked to sort of moderate this discussion a few months ago, financing the transition, I was obviously very excited. I said yes right away. And then when I had a chance to engage with the work of Ralph and Jennifer, I became even more excited, and just reading their papers. I'm very excited for what's about to happen and to hear kind of the two amazing perspectives, and I am sure you all enjoy this as well. So first off, we have Jennifer to talk about some of the impacts of financialization.
Thanks, Joe, for that nice introduction. And I'm very glad to be here today to speak on this panel on financing the transition. Though my comments today will probably veer more towards what's wrong with the current system, because we need to address that as a first step before we can get to creative solutions for the transition. So what I'd like to talk about today in my remarks, and we each have 15 to 20 minutes, so I might go quickly, and I apologize in advance, but I want to talk about the rise of financialization. I want to talk about how financialization reshapes economies in ways that can threaten and undermine the objectives of ecological economics, and finally, what we might do about it. So my first point on financialization. Before we talk about the rise of financialization, it's really important to understand how we typically think about the financial system in the economy. And typically, we've tended to assume that the financial system serves as somewhat as a base of the broader economy. And here we think of banks, for example, providing credit for production and exchange in the wider economy. So that's the typical perspective that we tend to think about. But I want to make the point that it's much broader than that. The role of finance in the economy is much broader than just serving as this credit base. And in fact, what we've seen in recent decades is a rise of what we call financialization. And some of you might be familiar with that word, some of you might not be, so I will define it for you. Basically, financialization typically refers to the growing role of financial motives, financial markets, and financial institutions within the broader economy. And what's different about thinking about finance in terms of a financialization process is that we see financial actors actually enmeshed throughout the economy in really interesting and new and complex ways, in ways that we might not even fully understand. So in other words, it's not just simply credit provision, it's also increasingly about investment. And what we've seen with this process of financialization is that economic growth and profits are increasingly occurring through financial channels within the economy rather than through what we might call productive or the real economy, which those are the productive economy or real economy might be somewhat problematic terms. But the basic point is that in financialized economy, we can see profits being generated purely autonomously within the financial sector through complex financial instruments. And that's new. That's different than we had seen in previous decades. So for example, in the 1950s and 60s, around 10 to 15% of growth in the economy was actually attributed to financial activities. And by 2008, it was 30 to 40% of economic growth and profits in the economy being generated purely by the financial sector. So that's a big shift. And I don't have the latest figures for today, but I wouldn't be surprised if it was much more so, simply because the financial crisis and the response to it by many governments, which was to lower interest rates, make borrowing easier, provide more liquidity. It's probably much more so because a lot of investors were borrowing money at cheap rates in order to invest in financial products. So I just wanted to dig a little bit more here about who are these financial actors? Who are we actually talking about here? And here, it's a range of kinds of financial actors that have taken a more prominent role in the economy. And typically, these are called institutional investors, but we're typically talking about investment banks, hedge funds, pension funds, university endowments, foundation endowments, sovereign wealth funds, asset management companies. Asset management companies are these big, giant companies that actually sell financial products to all these other investors. So that includes companies like BlackRock and Vanguard and State Street, et cetera. And these are some of the biggest financial titans in the world right now. BlackRock, just as a basic point, they manage $6.5 trillion, okay, so they're huge. Okay, and I didn't put it on the slide here, but I could have. We could add all of us. If you have a pension fund, if you have retirement savings, you are also a financial actor involved in this new financialized economy. So what kinds of investments are we talking about, and why are investors investing? This is where the motives and the new kinds of instruments come into play. That's part of this definition of financialization. What we're talking about here are typically a rise of new, complex financial instruments that are typically abstracted or disconnected from what we might call the biophysical economy. And so these complex financial products include things like commodity index funds or exchange-traded funds or mutual funds. You probably heard of mutual funds, or other kinds of financial derivatives like futures markets. There's land funds. There are all kinds of these complex financial instruments. What's interesting and unique about them, as I said, is they're disconnected in many ways from the biophysical world because they're purely financial in nature. But they're connected to the biophysical world in interesting ways because they're often tracking price changes in the real economy, but they are financial instruments. And these kinds of investments have drawn a huge amount of capital. Currently, we have around $80 trillion in assets under management in the global economy. And if you know what the value, I had to look it up, but it's interesting, the value of global annual GDP, $75 trillion. So $80 trillion in financial assets invested rivals the value of global annual GDP. So it's a big shift and change of this money going into this financialized world economy. Now that brings me to my second point that I want to make, which is that financialization, this process of financialization as it has occurred over recent decades, has been fundamentally reshaping economies in ways that threaten and undermine social and ecological systems. And you could pause and say, well, wait a minute, which many investors do pause and say, wait a minute. They say, well, if these are purely financial investments that we're making and it's disconnected from the biophysical world, then what is the problem? If money begets money on its own, it's completely autonomous, disconnected, then we don't need to worry about it. And I would say to that, not so fast. Just because financial profits are being generated autonomously, it doesn't mean that these investments are neutral in terms of the impact on the biophysical world or social and ecological systems. Economies are being reshaped in fundamental ways by the rise of these financial institutions, instruments, and investors. So that's what I want to talk about and give a couple of examples, drawing a little bit from some of the work that I've done on the agri-food sector. But first off, just to say, a key way in which economies have been reshaped is financialization is seeing financial actors increasingly seeking out profits in new arenas. We call this, seeking new arenas for financial accumulation. And that's basically what's going on, is that new instruments are being developed all the time to create interesting ways that financial investors can make more money from their money. And the way they often do this is to tap into profits on top of an underlying physical sector. So, for example, there's a lot of the money, this $80 trillion that's being invested, is actually financial instruments that are tied to the real economy. They might be indexed, for example, to changes in commodity prices. They might be indexed to changes in land prices, or they might be indexed to changes in the energy sector. So there is a link, and it may sound like, well, that's a tenuous link, what's the big deal here? But there's a problem, because what we see is that when money flows into these complex financial products, which are tracking prices, it can actually affect prices in the real sector. So if investors are buying futures in agricultural commodities or futures in oil energy futures, these affect future prices, which then trickle back into the real economy. So we've got these kind of commodity index funds. As I said, they're indexed to the price of these commodities. We're also seeing land funds. And there are also interesting financial products, which are, for example, carbon derivatives or even water future derivatives. So, as I said, the financialization then is reshaping economies in order to create profits in the financial sector, but on the back of new sectors in the real economy. But this kind of investment can have huge impacts on the real economy. So as I already said, it can bid up prices in commodity sectors, for example, leading to food price volatility that we saw in the run-up to the food price crisis in 2008, and that lasted through to 2012, 2013. We saw a lot of price volatility, and a lot of that has been blamed on the role of financial investors moving en masse into commodity futures markets, especially for agricultural commodities. Same, we can say, went in the energy sector. There were a lot of investors trying to get in on energy futures as they were seeing energy prices going up, and that only bid up prices further. So what that did in the energy sector is it actually made the kind of activities that we see as extremely environmentally damaging. For example, there was a massive increase in investment in the tar sands, and we heard a little bit about that last night. That wasn't necessarily profitable until oil prices had been up by financial speculation in the first place. The rise of fracking, for example. These kinds of investments into these sectors that affect the real economy, the real biophysical world, because of financial speculation. And same in the agricultural sector, we see this really huge push for increased production at all costs, and which often was externalizing those costs as production increased. So this first way in which financialization reshapes the economy in terms of creating new arenas for accumulation has real-world impacts. Now, a second key way in which financialization is reshaping the economy is it's prioritizing what we call shareholder values. And this is another area where a lot of financial investors are moving their money, and not just into commodities, but into shares in companies that are traded on the stock market. And, for example, we've seen a huge rise in passive investment in what are called index funds that are basically bundling together shares of corporate stocks. And so the investors are just, in a weird way, they're like the commodity index funds, they're just buying an index that tracks the price of the shares of these companies. They're not actually buying the shares of the companies. So you might say, well, how is this affecting the real economy? Well, first I just wanted to note how much it's grown. As you can see on the chart here, we've seen a huge rise in these kind of what are called equity index funds and exchange traded funds. In fact, they're worth now around $10 trillion. So it's quite huge. And this happened as commodity prices started to decline after 2014. And you know the stock market is booming. This is where investors are moving into the stock market. And one could say this is actually contributing to the stock market boom that we're currently having. And in my view, anyway, it's a big financial bubble. And it won't be pretty when it bursts. But that's another point. But as this is occurring, this is a really interesting trend that's emerging, and some of the latest economic research is pointing to this, which is that we're seeing what's called a rise of common ownership. So as I said, investors are buying these index funds. So who's actually owning the shares of these companies? It's actually these financial intermediaries, the asset management companies, the BlackRock that I mentioned, the $6 trillion BlackRock, but it's also companies State Street, Vanguard, Fidelity, Capital Group. What's really interesting is that since 2000 up until in this graphic to 2016, and because I look at the food sector, I was looking in particular at the agricultural input companies. This shows us the share of like the proportion of the stocks that are owned by these asset management companies has gone up enormously. So we're seeing that some of these companies, 20, 25, 30% of their shares is actually owned by financial asset management companies. What does this mean? I will tell you what it means. I'll tell you what it means. What we're seeing from this kind of prioritization of shareholder values and this rise of common ownership, we're seeing things happen like the recent mergers that happened in the agri-food sector, where we had 6 large companies, already big enough, then collapsing into 4 through a series of gigantic mergers. So what is causing this? Well, first off, this new economic research is showing that common ownership actually is associated with higher prices, and it weakens competition. So in other words, as asset management companies increasingly come to own the big companies that dominate the economy, they're encouraging these companies to pursue profit at all costs, and that often means pursuing anti-competitive behaviors. So they merge, they get bigger, they command more market share, they can raise prices. And this has got huge negative effects in society. So we're seeing this kind of common ownership raising prices. As I said, it's leading to mergers and acquisitions, so we're seeing corporate restructuring. Oftentimes, shareholders are pushing companies to do those mergers and acquisitions, not just to get more market share, but so that they can fire a lot of people and be more efficient. They call this lovely term, they use a euphemism called synergies, is what happens when corporations merge. And it basically means people lose their jobs. And what we're seeing is increasingly, if you've only got 3 or 4 companies dominating a sector, those companies have a lot of say in terms of what products look like and what's available. So our choice is reduced, and oftentimes these products reflect profitability, in other words, what they can sell for money, rather than sustainability goals. So again, if we took the agriculture sector, which is the sector I'm looking at, all of the companies that dominate the market now, they're all offering the same industrial agricultural products, genetically modified crops, and a heavy dose of pesticides. And other kinds of agricultural production models, such as agroecology, small-scale farming, those aren't profitable for these companies, so they're not doing any research in those areas. So just to sum up my point then here, the second big point I wanted to make about reshaping economies, financialization matters, and I think it matters for ecological economics, and that we as ecological economists need to be concerned. It basically ends up prioritizing profits in the economy, which has a real effect on the underlying assets, including nature. It reinforces inequality through these corporate restructuring and the concentration of wealth. And it incentivizes inefficiencies because it's anti-competitive. And so if you recognize this graphic from the wonderful Ecological Economics textbook by Farley and Daly, these are the very issues that ecological economics is concerned about. They're concerned about scale, they're concerned about distribution, and we're concerned about questions of efficiency in that order. But all of these pillars of the field are being challenged by the process of financialization. Okay, so to my final point, what can we do? So obviously, given the significance of finance in shaping the economy and shaping the ways in which we interact with our socio-ecological systems, finance can be a really important lever for change. It's an important sector, and we have to pay attention to it. If we ignore it, we would do so at our peril, because these forces are very powerful. We're talking about a lot of money that is pushing economies in new directions. So if finance is an important lever for change, how might that work? We often hear, I'm not the first person to say finance is important. There's actually a lot of people saying finance is important. But a dominant approach is to say, well, we can have more sustainable investment. Instead of having these investors putting their money in these kinds of financial funds and complex derivatives that can cause harm, why don't we ensure that people put their money in sustainable assets, okay? And here I put up a graphic of that I found of the growth of sustainable investment over the past decade or so. And it's been phenomenal. The industry now claims that around $30 trillion of the investment, of that $80 trillion in assets under management, is actually in sustainable investment funds. And that should make us all feel good, or does it? It's been so remarkably quick that even publications like the Financial Times, which is not a radical newspaper, I'll put it that way, but it's very informative if you read it, they even say this is a worrying trend, because how could all of these investments possibly actually be sustainable? I've seen estimates saying that only 1% of assets are actually sustainable, and this is over a third. So there are reasons I would argue that we should be cautious. First off, most of the sustainable, refers to SRI, sustainable, responsible, and impact investing. Most of that is actually about corporations taking what are called ESG, environmental, social, and governance issues into account, or negative screening. So in other words, not investing in tobacco or gun companies, for example. This is important, obviously, but there are instances where companies are rated high on ESG goals simply if they say yes, climate change is an issue, even if they do nothing to address climate change. So there's a big potential for greenwashing in terms of what is labeled a sustainable investment. And there are now pushes for criteria, hard criteria in third-party auditing, but we're not there yet. And so it's like the Wild West, and investment funds are claiming all over the place that they're sustainable. But we have to be cautious and really look hard if we want to invest our money and think that it's sustainable. And there's another big issue with this kind of approach, which is that it's saying we can change the financial system from within. So by moving towards more sustainable investments, even if they were truly sustainable, this kind of approach really reinforces the very system that it's trying to address. And you have to raise questions about whether working within the system is actually still going to work, because it creates those incentives for greenwashing, for example. And this is borne out if we look at the data on the actual, what we call impact and community investing, which has the highest, most stringent criteria for sustainable investing. It's tiny by comparison. 30 trillion claims to be sustainable, only 500 billion is actually in that impact investing. And even in that impact and community investing, there are a variety of kinds of claims about what those investments are actually doing. So it's a start. It's important that we're recognizing this issue, but I would argue we need to go much further. I argue in my own work that we need regulatory reforms, and that these reforms need to be very strong if we want to rein in the power of finance and the way it's reshaping economies. One key way to do that is financial sector reform. For example, we need the kinds of regulations that they tried to put in place with the Dodd-Frank Act in the US, but it's been gradually peeled away and shipped back. But putting limits on how much investors can speculate on commodities, for example. That was one of the big proposals of the Dodd-Frank Act. And it's a good idea. The European Union is also pushing this idea. And I'll talk in a minute why that's difficult. And I also think we need stronger what's called competition policy, or in the US they call this antitrust. Policies that rein in these kind of anti-competitive practices and raise questions when corporations try to merge. And these kind of antitrust rules as well can put in rules about common ownership. They can say these companies can't be owned by big asset management companies. They need to spread out their ownership more evenly, which would be a more democratic way to approach this situation. So reforms are important, but garnering the political will, I'm not just an economist, I'm a political economist, so I'm always thinking about what's feasible, what can we do? And garnering the political will for these kind of big changes is extremely challenging. So why is it challenging? First off, the linkages are complicated and the effects are distanced. And I put a lot of work into thinking theoretically about these issues, but really the cause, financial investment, and the effect, these impacts on the environment, either through tar sands or commodity extraction, these causes and effects have multiple steps in between. And as I said, the financial investors don't think that they're any part of the problem. They're like, we're just investing money based on an index. We're not to blame. And so the cause and effect are quite separated. And that makes it challenging and difficult to campaign on these issues. Moreover, they're so complicated, the rules are so complicated, it's difficult for NGOs, for example, to get right in these debates on financial reforms. So that's a problem. We also see that individuals are increasingly enmeshed in this system. So we ourselves, as saving for our retirement or pension funds, et cetera, we have a vested interest in this system. And so it's hard to get people to agree that we need to change it. And finally, the financial industry is huge. They have enormous lobby power, and every time these kind of proposals come up, they fight back. I'm just going to share with you some graphics here of the amounts of money that the financial sector spends on annual lobbying and campaign contributions. This is based on US data from the Center for Responsible Politics. They're spending over $1 billion in election time trying to lobby politicians. So that's why it's important we're having this conversation, and I look forward to the question and answer period at the end, and I'm looking forward to hearing what Ralph has to say. And if anybody's interested in reading more about financialization through my work on the food sector, I put a few things up, my recent book, Speculative Harvests, as well as some publications, and thank you.
that was, and kind of a dork, that was super fun, super exciting and engaging, also a little bleak, but I think that's what we're here to engage with. Super happy to hear what Ralph's about to talk about. We're kind of addressing some of these issues. Thanks, Ralph.
Thank you. It's a real pleasure to be here, and I agree with everything that Jennifer just said. I also like the format of this conference, so congratulations to the students for making this happen. What I'm going to talk about is a strategy for sort of financing a transition, which I'm calling here inclusive capitalism. It could be called something else. It could be called binary economics or two-factor economics, and how this needs to be linked with sustainability at a fundamental level. For the past 20 years, I've been working with some colleagues on a sort of project that we've named in a book called Technology, Globalization, and Sustainable Development, and How Do You Transform the Industrial State. At the heart of this book is a conversation about technological change, innovation, globalization as very powerful drivers of change, and you've just heard why that's the case in financialization, and how these impact three operationally important dimensions of sustainability. This is the economy, work, and the environment. And when I put this up in front of students, the first question they tend to ask is, well, why are you separating work from the economy? And what I'm going to try and do is explain why that's really important to understand work and the economy separately, and then what sort of that means in terms of what we might do for solutions. The first issue I'm going to talk about is job polarization and the hollowing out of the middle class. And the easiest way to do that is to look at some of the trends that have been happening. In this graph here, you see labor productivity, real GDP per capita, private employment, and median family income. They track together from the 50s to about the 1980s, and then you start seeing a decoupling occur. So you have productivity and GDP sort of continuing to pull away, and job prospects and certainly income flattening out. So here you've got median family income basically being flat for about 4 decades, while the GDP of the economy is pulling away. Now, this graph is really important to understand the polarization of the workforce. So if you look at the types of categories of jobs on the bottom axis, they're grouped by low-skilled, middle-skilled, and high-income jobs, essentially. What the bars mean are different time periods. So the blue bar is 1979 to 89, the orange bar is 89 to 99. And if you look at the more recent time periods in gray and yellow, what you see is the middle-skilled jobs are declining over the past 10 years or so or more. And this is what's referred to as the polarization of the workforce. We're losing middle-skilled, middle-income jobs. This is data from America. What's happening, from what I can tell, from what I've been able to find, is about 1/3 of displaced people are able to move up, but 2/3 move down into contingent work, which is now TaskRabbit, Uber, Lyft type employment, so non-long-term and contingent. If you look at other countries, you see exactly the same data. Now, this is in the EU, and this graph basically shows in the black bar middle-paying jobs declining across the board. The bars either side of the black bar are growth. They sort of signal growth in high-income and growth in low-income jobs. So again, this polarization process is ongoing in many industrialized nations. In line with that, there's been a 3-decade decline in the share of wealth going to labor. And so if you look at this graphic and you focus on the blue line, what you see here is wages as a percentage of GDP. So right now, the predominant way to distribute wealth is through wages. And what this indicates is that since the 1950s to about the year 2000, there was a slow decline from about 65% of GDP going to wages down to about 60%. In the last decade or so, you've seen that decline much more significantly. And it's not just in the US, it's happening in many industrialized nations around the world. And at the same time that you have less GDP going to wages, it has to go somewhere, and it's going to corporate profits, right? And so why is this happening? Well, trade, financial openness, financialization, you've just heard why that's such an important problem or issue. Changes in corporate taxation, labor union decline, automation, and other factors. What I'm going to sort of argue today is that if in this new age of sort of automation, AI that we're moving into, if production becomes more capital intensive, the way we distribute wealth will also have to be connected to that capital. And I'll come back to that idea in a moment. There's also been an increase in cost of living. So while median family wages have been pretty stagnant for the majority of US citizens, you can see at the same time over the past decade, what's happened is there's been a tremendous increase in education costs and healthcare, where there has been some competition in goods and some services. You see the price of those assets or products stable or declining. So if you're poor, healthcare and education are very expensive relative to other things that you might be purchasing. There's been a growing growth in income and wealth concentration and inequality. Here's a snapshot of wealth in the US in 2016, and you can see the vast majority of wealth is captured in the top 10%. And you also have trends such as this. This is an Oxfam report that came out last year, and it basically said in the year 2017, 1% of the global population took home 82% of the wealth created. And I think you've just heard how that happened in the previous presentation. These factors, 1 through 4, essentially, speaking in terms of sort of economic terminology, it results in a decline in effective demand. People don't have the income they need to buy basic goods and services. And this is leading a renewal of interest in the sort of conversation around universal basic income. All of these ideas are connected. The problem is not really the challenge of producing more. I think right now, if people had money, they would go out and spend, and the production system would respond. That's what concerns me. So the problem is how to ensure that what we do is profitable, is equitably shared or distributed, and is inherently sustainable. So we're investing in things which have an inherent sustainability about them. Two really important trends which have to be connected in any solution we put forward are the environmental challenges and the economic. You know, this is the iconic climate change curve on the left, and you've got the one I've just showed you about wealth distribution on the right. But you could replace that climate change curve with any number of metrics looking at environmental concerns. This is a graph that just came out of the UN report on biodiversity, showing rapid rates of increased extinction rates in a whole range of amphibians, mammals, and so forth. The problem I also see is that if you look at the way sustainable development is typically talked about at an international level, certainly by the US and EU, it tends to lean into this technologically optimistic set of solutions for sustainability. And as I've just mapped out with these troubling realities, if we're going to lean hard into hyper-efficiency as a way to solve energy problems and environmental problems, it may further polarize the workforce and pull the rug out of wages as a way to distribute wealth in the economy. So these are connected problems, and they have to be solved together. So while energy and environment will certainly be at the forefront of sustainable development considerations moving forward, I would predict, based upon the data that I've just put out there, that they'll be accompanied by this conversation about how do we have meaningful, rewarding employment, adequate purchasing power with those jobs, because remember, the hollowing out is medium income, middle income jobs are being displaced, so a few have high-paid jobs, and a majority will have low-paid jobs. So there has to be this other mechanism, which is increasing earning capacity through some kind of ownership or basic income system. Now, in our work that we've been looking at, just on the inequality question, we've been exploring a whole range of ideas such as cooperative economy, different ways to think about designing jobs back into the production system. But today I'm really going to focus on just one set of ideas: universal basic income, negative income tax, and also something that probably very few people in this audience have heard about, which is binary economics. And this idea is a way of essentially letting money pay for itself. It's acquiring capital ownership with the future earnings of that capital, and this would be done in a way that would broadly distribute the ownership of the future wealth created. And I'll come back to this in a moment. So one of the things I've been doing for the past year is starting to explore and look at these universal basic income mechanisms and ask questions such as, well, how do they work? How are they financed? What amount of money are we talking about? Is there any theory behind them, or is it just this is how we can distribute money? And what is the connection to sustainability? Again, remember, you've got to think about not only the inequality issue, but also how does it link with sustainability? So the negative income tax idea has been around for quite a long time. It would be a tax system-based approach. The amount people would receive would vary. Essentially, there'll be a minimum threshold if you're of income. If you fall above that, you would pay a tax. If you fall below that, you would receive a tax. It was developed by Milton Friedman, and essentially there's no sustainability considerations. It's just the movement of money around. Last year, the UK Labour Party put forward an idea for an inclusive ownership fund. This idea is for companies with more than 250 employees that have to transfer over 10 years, 10% of their ownership to this fund, 1% a year for 10 years. Then workers only within that firm would receive up to $500 a month extra in terms of their pay, and any remaining money left in that account would essentially go to government to pay for basic services. There's no direct theory behind it, but it really was driven by a financialization argument and the concentration of wealth and ownership being destabilizing factors in the UK economy. No direct sustainability considerations. Now, if you're following the US political process in the 2020 presidential election, you may have heard of Andrew Yang. He's basically putting forward a universal basic income platform in the United States, which, if he is elected, will be implemented, he says, in January 2021. He would pay for it with a 10% VAT on tax and reducing welfare programs at the same time. Every citizen over the age of 18 would get $1,000 a month, regardless of whether they're employed or not. There's no economic sort of theory at this point behind it, but it's really driven by a very strong argument that automation and AI are displacing jobs. And if you look up his platform, you'll see that narrative coming through very strongly. There's no, at this point, direct sustainability consideration. And it was this idea for universal basic income that actually got me interested in this space, because I've been interacting with Andrew, trying to convince him about thinking about the environment. Chris Hughes, the co-founder of Facebook, has argued we need a guaranteed income for working people. Note the emphasis on working people. There's a difference between these programs. Some require work, some don't require work, and then there's different financing mechanisms. This is a tax that would be financed by a tax on income over $250,000 a year, which would underwrite the program. Families in households with less than $50,000 a year, adults, would get $500 a month. Is basically based on this idea that there's growing income inequality and we need to address it. There's no direct sustainability consideration. If anyone's from Alaska, you'll have seen, you know about the Alaska Permanent Fund. There's essentially a tax on extraction of non-renewable resources, and essentially what happens is that money goes into a fund, the fund is invested, and every year there's a payout of between $1,000 and $2,000 per resident of Alaska. It's based, there's no economic theory directly behind it, but it's sort of premised on this notion that we have to share the national wealth. There is no direct sustainability consideration. Now, the American Solidarity Fund is an idea which is very similar to a sovereign wealth fund, but where sovereign wealth funds are normally resourced by taxes on extraction of minerals, or in the case of China, taxes on manufacturing processes. This would be financed, the idea is it would be financed through taxes on basically financial transactions, voluntary contributions from wealthy individuals, and then the investment of this fund would essentially create a dividend payment that would go out to every citizen in the US over the age of 17. It's based on this sort of very strong capital ownership model. It's very similar to it leans, I think, more into the financialization metrics or ideas that were just discussed. And the sustainability angle on this is that, in theory, the investment of this fund would go into companies that aren't having human rights violations or causing environmental destruction. And I think Jennifer just raised some questions about how well we're doing on that kind of idea. Peter Barnes has talked about Commonwealth Trust. This is kind of interesting. The idea, it's really just an idea right now. What would happen is ecosystems would be put into trust for asset preservation, and that's sort of the paramount mission of the trust. And anyone that wants to use those resources would then have to pay for the privilege to do so. Now, that could be quite interesting in contexts where you really want to protect ecosystem health. Every citizen in the US would receive a dividend payment from the wealth generated from this system. In theory, there's no sort of economic theory behind it, but it is based upon this premise that everyone should share in the common wealth. From a sustainability perspective, those charged with managing the system would be accountable, in theory, to future generations and would have authority to limit the use of ecosystems. So that's sort of an interesting idea. And then the final idea here is Robert Ashford's notion of inclusive capitalism. And I've been connected with Robert over the past decade or so, trying to understand his theory of binary economics. Essentially, the way this would work is you would have a trust that would invest on behalf of citizens in what we would like to see as inherently sustainable development. So I was thinking after last night's presentation, there was a sustainable prosperity index idea put forward. So in terms of how do you know what to invest in, there are metrics, there are systems now we have which can indicate whether an investment will be good or not in terms of sustainable development. So the idea is this trust would invest into growth of the types of things we want to see grown, and then the future ownership of those, if that growth works, the future ownership would be distributed to everybody. They'd have an actual ownership stake in that growth created. It's an investment in the real economy, and it's not a financialization type of a system. So you can see this is the last kind of 5 years, 10 years of ideas being consolidated and more coming over time. What I was just interested in doing is thinking about, well, what happens when you think about these from a theory perspective? Are they just ideas, or are they coming from some grounded theory? Is the money that they would enable or share or distribute available to everyone, or is it constrained to just workers? And you can see there's only a couple of these options that have real constraints to workers. Is capital ownership a critical piece of this, so you actually own something? Now, I think this is really, really important. If you have a distribution system like a negative income tax, you could have a change of administration and that can be pushed away. If you actually own something, you have a connection to it legally, it can't be taken away. And what I've been really thinking about is how do you structurally change the landscape so what you put in place works for everyone and is sustained over time. And in terms of sustainability, only a few of them really think about that directly. So if you remember the two ice hockey stick curves, I'm looking for possible solutions that can address both of those at once. And you can see there's a handful that begin to lean into that space. The final thing I'll say is this production, distribution, consumption cycle for sustainable, inherently sustainable goods and services is the type of thing I think we need to think very carefully about. So how do you, one, finance inherently sustainable production? How do you provide ownership of the wealth created to everybody? That will then directly be distributed, addressing this inequality challenge, maybe raising the minimum floor so people can essentially buy basic goods and services. And then the question is, what happens with that money? And right now, this is sort of an open question. Most of the universal basic income ideas are saying, just spend it. And so what I'm thinking about is, well, how could we have some kind of system to recycle that money back into what we want to see developed, the more inherent sustainable goods and services. So, if you really want to think about how do we turn these trends around, the challenge is to take on the entire system. If you just focus on climate change, you're going to have a response to CO2 and other climate-related emissions, but you may have domino effects in jobs. You may have other unforeseen impacts. In the context of sort of environmental issues, the evidence and research I've seen says that if you focus only on reducing emissions, for example, what tends to happen is those emissions are captured and pulled into the workspace, increasing occupational health and safety risks. So this is a complex system, and it will take a set of ideas to really try and transform what we currently have. And what I'm promoting or saying here is really a way to think about the emergence of something new alongside what we have. And this is a transition, right? This is, you have different ways that change can come about. What I would like to see is the growth of something we want to see and the decline of things we don't want to see. And so this is one way that could be achieved. So I think that's all I have, so thank you. Gonna go?
Okay, that was fun. I had a blast listening to that. I am going to lead off with a question or two and just sort of get a conversation going amongst the two of them while we have some questions that are sort of gathered from all of you. And then as they're kind of discussing, I'll grab those questions and then deliver them to them as well. So one of the things that I heard, and I don't want to put words into your mouths, but I heard a lot of talk around the idea of rate of return. It was sort of problematized maybe in the first chat, this idea that the rate of return leads to increasing financialization at a certain point. And then Ralph, you sort of addressed this rate of return, through an inclusive capitalism, maybe we can utilize this concept a little better, more equitably. So just talk about this idea of rate of return, what is the role of that, if there is one in the future?
Right. Should I start out?
Please.
Yeah, well, I think a lot of the rise of the financialization process in the first place was financial investors seeking a higher rate of return. And so, for example, the move of financial investors into the food and agriculture space, the case I'm most familiar with, in around 2008, was actually partly the result of the publication of an academic study showing that investment in commodities was a good hedge against volatility in stock markets. And so a lot of investors simply moved over into the commodity sector because they were seeking returns and they were seeking more stable income. And so as they did that, it actually bid up prices in that sector, which then drew more money in because it appeared that prices are going up. This is actually a really good strategy. And so, but once everybody crowded in, the markets kind of collapsed because it created a bit of a bubble. And so I think you're absolutely right that what we're seeing is that as we, as individuals, for example, we're increasingly the management of risk of whether we will have retirement savings, just take that as an example. It's increasingly being downloaded on us as individuals. So people used to have pensions with their companies or with their governments and thinking, oh, everything will be fine when I retire. But as we're seeing these pension funds are being depleted and with demographic change and also governments clawing back the amount of money that they put into these systems, then individuals want to take part as well. And so basically, everybody in the whole society, I would argue, is increasingly focused on this rate of return. And that's partly, I think, explaining the crazy stock market right now as well. And it's creating this self-fulfilling prophecy that I don't know how long it will last. Anyway, I don't if that answers your question, but I think this is driving a lot of what's going on, is this expectation that everybody should be able to get some kind of rate of return on their assets. And I think maybe we need to rethink that in the ways like that Ralph was talking about. So I'll let you speak to that question.
Yeah, I mean, essentially the binary economics model is one of growth into the types of things you want to see grown. I mean, there was a very interesting conversation about degrowth yesterday. I view degrowth in a deconstructing growth way, right? Some things will need to grow, other things will certainly need to decline. And so what I would like to see is opportunities for growth into the types of goods and services that we're hearing and receiving as food at this conference. I mean, there's ways to do sort of cooperative ownership models, right? And so, we have benefit corporations, employee-owned firms, credit unions, right? There's a whole range of ways that we can shift the types of ways we finance and engage with money and development. I think right now it's sort of what your presentation was a perfect sort of description of the current system we have. And so what I've been thinking about with my colleagues is how do you put in place something that is viable and will allow this kind of shift or transition to that new space to occur. The alternative is some kind of collapse and then a reboot. But then the question then is what is put back in place? Do we go back to what we just tried to sustain or something very different? So having spaces to basically experiment to a certain extent to see what happens, I think would be a really worthwhile endeavor.
Yeah, so taking the idea of experimentation and the idea of engaging with money. Jennifer, I've read some of your work on engaging with the positive money movement in the United Kingdom. And this is a question from the audience. Any comment on 100% money, whether to change the role of private banks away from creating most of the money? I'd be interested in your thoughts on that.
Yeah, well, I think the positive money movement is really interesting, and for those who aren't familiar with it, I'm sure there's some people who are more familiar with it than I am, but the idea that instead of banks creating money through lending, that we have committees, government committees deciding about money supply, which moves us away from this boom and bust kind of economic cycle and instead is more stable. And I think it's a really interesting idea, and I think especially at this particular juncture where if you followed monetary policy since the financial crisis, we've had extremely loose monetary policy where governments have very low, Federal Reserve, for example, in the US, and the Central Bank of Canada, setting very low interest rates for years and years on end in order to stimulate the economy. I mean, basically what this is an invitation to banks to create more money, which turbocharges the economy by just injecting enormous amounts of liquidity. And that liquidity, as I said, is going into some of these crazy financial investments, but it's also corporate borrowing. We're at a situation right now where corporations are super leveraged, and what they're doing is borrowing money to buy up rivals and get bigger, and it's creating those inequality problems that Ralph talked about. So I think getting a handle on how we decide how money gets into our economy through initiatives, perhaps the positive money is one way to do that, I think could really reduce some of the negative cycles that we're currently seeing.
I don't really have anything to add. I think that was...
Then I have a great question for you, Ralph.
Okay.
Do you know of any examples of common asset trusts in operation?
Well, the ones that I looked at, the only one that's really in place is the Alaska Permanent Fund. I mean, that's got a long history. The rest are ideas, essentially. But what's interesting is, there's been some really fantastic conversation and presentations at this conference, and what I'm hearing is the need to reshape the value system which guides investment and decision making. And so some of these emerging ideas I think, are worth exploring by the community in the sense of, well, how might you have sort of indigenous ideas embedded in the investments that people are thinking about? I mean, this whole well-being idea, not just of individuals, but of everything, I think is very powerful and interesting. So, what I'll be taking away from this conference is a new sort of landscape of ideas, which maybe I can bring back to these kinds of early sort of trusts and sort of these wealth ideas for how do you capture wealth and share it and distribute it. I mean, this back to the three things you were talking about, distribution being one critical component. And I do think there is something very valuable about sort of having land and ecosystems in trust. And then having the people that understand those systems manage them. I think that would be a very interesting pathway forward.
And could I just add to that? I mean, just the situation of this growing recognition of this problem of common ownership, where you've got 5 asset management companies owning huge proportions of corporations. That why are we concentrating ownership among these financial companies? It doesn't make any sense. The ownership, as Ralph was saying, I think it's a great idea to spread out that ownership amongst the people who connect to it, the people who use it, rather than this concentration of wealth.
So again, I'm hearing, this is such a fabulous conversation. I feel like the answers lend themselves into the next questions. But I'm hearing a lot of talk about ownership, obviously regulation, and kind of what is the role of regulation. We're getting some questions on top-down versus bottom-up. And we have chatted before this session on the role of the state. So I'd just be interested in hearing what are your thoughts on the role of the state, because I think the capitalism, socialism sort of tired conversation is rearing its head again in the last 2 years. So I'd just like to hear the thoughts.
Do you want to start, Ralph? Or?
I'll take a crack. So, this work is essentially a governance piece of work, right? It's there's a role of government in basic education and skill, like sort of, at least as we currently have the system set up. It provides physical, legal infrastructure, architectures which shape what we do. So I'm very interested in understanding the frameworks that shape what we're currently doing, and then how do you change those frameworks? When I put that triangle up with employment, work, and economy, I mentioned they are levers of change. In each of those areas, you have very specific legal and policy and investment actions around protecting occupational health and safety of workers, protecting the environment from toxics, promoting economic activity. So if you understand all those levers and change, you can then start thinking about creating a framework to allow this sort of creative destruction into inherent sustainability that I would like to see. So I think there's an absolutely fundamental role of setting the landscape in place, setting the legal architecture in place. So that's what you expect people to operate within. What I don't support is basically saying you now need to do this within that framework. I think you mentioned sort of socialism, capitalism. I think it's time to sort of really move into a blended version, right? So there's power in both, and what I hope came across in this inclusive capitalism, like I said, could be called something very different. It's taking the essence of creativity and innovation and blending it with a broad distributed ownership. And the idea is to have sort of an economic democracy to a certain extent. So that's kind of my personal view.
That's great, thank you.
Yeah, no, I think it's a really good question. In particular, do we try to address these problems from the top up, top down, or bottom up? And I would argue that we have to think about the top down and bottom up together in a coordinated way. So there's a lot of discussion in sustainability, transition literature, for example, of the need for bottom-up initiatives and scaling things up and scaling them out. But my strong argument, I think, in everything I've studied in the last 25 years, has been that if we don't open up the space for those alternative initiatives to thrive, they're not going to thrive. And part of the reason is the weight of these powerful financial and economic actors in the global economy are pushing down and closing off those opportunities. And so what we see are these little niches, and they stay niche, they stay small. If we want these alternatives, the 1,000 alternatives we talked about last night, to flourish, what we need to do is break the power of those corporate actors, of the financial actors, and create space for alternatives. So I think, although sometimes I get criticized because I think there's a really important and strong role the government can play in setting these kinds of regulations, because states as I already acknowledged in my presentation, states are often co-opted by these very actors that they're trying to regulate. And so it's a very difficult area, which is why I study politics as much as I study economics. But I think that this is one of the key ways that we can create those kind of spaces, because if we just ignore the financial actors and the giant corporations, like, it's easy to ignore them. I've never been in a Walmart, and I hope that I never will walk into a Walmart, and I made that as a personal choice. But the fact that I won't go into Walmart is not making Walmart go away. So I think we need to really coordinate and think about the positive role that the state can play in setting these kind of regulations. And just to say, it's an exciting moment. There's this neo-Brandeisian movement of antitrust that's emerging right now in the US. It's super exciting. The original antitrust policies in the US around corporate concentration were about checking political power. And over the next 100 years, the rules and regulations gradually became about economic measurement of whether prices were going up and down in the face of a merger. And that's not what the original rules were about. So this neo-Brandeisian movement is trying to check that political power as much as the economic power of big corporations. And there also is, movements for financial reform. And there are some good players in these contexts, and they're fighting tough battles. So just to say, like, every time these kind of regulations come forward, the companies come back. I mentioned that they're lobbying. It's not just that. Like, they're filing lawsuits, for example, against the Commodity Futures Trading Commission, trying to stop them at every turn. Or these economists who are revealing the impact of common ownership. They're actually being personally attacked. BlackRock is hiring consultants to write economic papers to criticize the methods of the scholars that are doing this work. It's crazy, but it's a battle that we can't just ignore. We have to engage in it. So, sorry, that was my little impassioned.
Yeah, the question of top-down, is it useful? I mean, this conference has revealed a lot of really interesting new research, and I've got some notes here from, I don't know if Olaf Weber is here from Waterloo. He did a very interesting presentation yesterday about how banks that invest and have a sort of a sustainability performance sort of ethos in what they're doing have better financial performance. But the reason they have this sustainability component in what they do is because they're mandated by regulation to do it. And so that's very interesting, that actually those kind of influences can actually lead to banks performing much better in terms of profitability. Now, again, the question is, well, what's really happening in terms of the investments? But I think Jennifer's exactly right. It's a top-down, bottom-up thing. You can't have one only. There needs to be some structure and architecture that guides the system and interactions and exchanges and what's happening. But there also needs to be a total open space for creativity, innovation, and freedom of expression of things to happen. And I think it's that balance that you need to just keep working at constantly. I don't think you'll ever be done. I think it's something you'll go too far, and then you have to go back, and then, and that's part of being in a community.
So we've got about 1 minute, so the two of you get 30 seconds to tell me and everyone else, what is the most effective leverage point for getting to the future we want? 30 seconds, and I'll be mean.
The most effective.
That's it.
I won't say what's most effective. I think that one of the first steps, I'll just come back to my point, one of the first steps is we need a better regulatory framework. And then we can move on, as Ralph said, to sort of this creative space that we need to open up.
I mean, you're asking someone who wrote a 700-page book to say something in 30 seconds. I mean, I think you really, really have to understand what's happening, the trends and the directions they're going in, and then you can begin to formulate meaningful approaches to address them. And so that's why I think it's inevitable that at some point we will have to have broadly distributed wealth. And that space of broadly distributed wealth is where I think I will focus a lot of my future attention. And whether it's a trust, if it's binary economics, or if it's negative income tax, there's the politics of all of those we'll have to play out, and we'll see what we get. But it will come. I think it's inevitable, in my opinion.
So distribution of wealth and strong regulatory framework. That's great. Thank you so much. It was such a blast chatting with you all this morning.
Thank you. Pleasure.